Taxes are everywhere. Governments use taxes to pay for essential services like roads, schools, and hospitals. One type of tax is called an indirect tax. What makes it indirect? Well, instead of paying the government directly, you pay the tax through someone else, like a store. Think of it like this. You buy a candy bar. The price you pay includes a little extra that the store owner will send to the government. That little extra is an indirect tax. Indirect taxes are usually included in the price of goods and services, so you might not even realize you're paying them. They are a common way for governments worldwide to raise revenue. Here's how indirect taxes usually work. A business adds the tax to the price of the product or service they are selling. When you buy that item, you pay the price, including the tax. The business then collects the tax money and sends it to the government. It's like the business acts as a middleman between you and the tax collector. Indirect taxes can be a percentage of the price, like a sales tax, or a fixed amount per unit, like an excise tax on gasoline. Governments can adjust these taxes to influence consumer behavior or raise revenue for specific purposes. Indirect taxes pop up in many places. Have you ever paid sales tax on clothes or groceries? That's a common example of an indirect tax. Another example is the value-added tax, VAT, which is used in many countries around the world. With VAT, a tax is added at each stage of production and distribution of a good or service. Even your dream vacation might involve indirect taxes. Many countries have taxes on airline tickets, hotel rooms, and rental cars. Section 4, Direct versus Indirect Taxes, Spotting the Difference. Now, let's compare indirect taxes to their counterpart direct taxes. Direct taxes are paid directly to the government by the person or entity responsible for the tax. For example, income tax is a direct tax because you pay it directly to the government based on your earnings. Property tax is another example of a direct tax. The key difference is who pays the tax directly to the government. With indirect taxes, businesses collect the tax from consumers and pass it on. With direct taxes, individuals or entities pay the government directly. Section 5. Weighing the pros and cons of indirect taxation. Indirect taxes have both advantages and disadvantages. On the plus side, they are generally easier and less expensive to collect than direct taxes. They can also be used to discourage the consumption of harmful goods like cigarettes and alcohol by making them more expensive. However, indirect taxes can disproportionately impact low-income households, who may spend a larger portion of their income on taxed goods and services. They can also be complex and difficult for businesses to navigate, especially when dealing with multiple tax rates and exemptions. Overall, indirect taxes are an important part of modern economies, providing governments with a flexible tool to raise revenue and influence behavior. However, it is crucial to carefully consider their potential impact and strive for a fair and balanced tax system that benefits everyone.